Japan just walked away from America's trillion-dollar dream. SoftBank didn't trim. It erased every last share of Nvidia, $5.8 billion gone in one move. They're not waiting for the crash, they're walking before it hits. While Washington calls this confidence, Tokyo's already cashing the exit slip. The yen jumps, the dollar slips, and the world's richest tech bubble suddenly looks like a countdown clock. If Japan's bet is right, this isn't a correction. It's the opening scene of the dollar's retreat. According to Bloomberg, the decision came after weeks of internal debate inside Masayoshi Son's empire, a move that sent tremors through both the AI and currency markets. Reuters reported the sale wasn't just profit-taking. It was a strategic withdrawal from what Son privately called an overheating American illusion. Hours later, Japanese traders dumped U.S. tech futures, and the yen surged against the dollar for the first time in 6 weeks. At the same time, U.S. Treasury Secretary Scott Bessent appeared on CNBC insisting there is no bubble. His calm tone contrasted with the data flashing behind him. Nvidia's price-to-sales ratio had hit 40 times, the highest for any megacap in history. The Financial Times noted that Nvidia alone now carried a larger market capitalization than the entire UK FTSE 100 energy sector. Even Tesla at its peak mania never touched that level. In Tokyo, brokers called it the SoftBank signal, a phrase that once meant early-stage optimism, but now meant exit. Bloomberg Intelligence calculated that AI-linked U.S. equities accounted for nearly 29% of total S&P 500 capitalization, a concentration unseen since the dot-com era. When SoftBank liquidated, it joined Norway's sovereign fund, which had already trimmed $11 billion of U.S. semiconductor exposure earlier in October. The parallel between them was unmistakable. Global capital, not retail speculation, was leaving the table. Within 24 hours, the Nikkei 225 fell 2.8%, while the Philadelphia Semiconductor Index plunged 5.4%. Reuters quoted one Tokyo trader saying, "This feels less like profit-taking and more like a rotation out of America." The reason became clearer the next morning when Bloomberg revealed that SoftBank had reallocated most of the proceeds into domestic chip design and AI infrastructure in Osaka and Hokkaido, a national push aligned with Prime Minister Sanae Takaichi's industrial revival plan. Japan wasn't just selling U.S. chips, it was building its own. In Washington, Bessent dismissed the sell-off as short-term volatility. Yet Treasury auction data told another story. In the first week of November, foreign demand for 10-year Treasuries fell 18% year-on-year. Japanese holdings dropped below $1 trillion for the first time since 2019, according to U.S. data. As the yen strengthened, Japanese institutions repatriated funds to hedge domestic liabilities, amplifying downward pressure on the dollar. The Wall Street Journal noted that the U.S. fiscal deficit had widened to $1.78 trillion for fiscal 2025, equal to roughly 6.3% of GDP, higher than during any non-crisis year in history. Despite Bessent's public claim that tariffs were reducing the deficit, Treasury's monthly statement showed tariff receipts totaling only $98 billion over 12 months, less than 5% of total federal revenue. Meanwhile, interest payments on the national debt surpassed $1.05 trillion, exceeding defense spending for the first time. The contradiction deepened when Trump renewed his Made in America tariff offset program, adding new levies on electronics from South Korea and the EU. The Financial Times calculated the effective import tax on consumer goods had climbed to 16%, nearly triple the pre-Trump average. Retail prices responded instantly. Bloomberg's consumer tracker showed average electronics prices up 12% year-on-year, the sharpest rise since the 1980s. Inside Silicon Valley, companies scrambled to preserve margins. Oracle's debt insurance spreads hit a 2-year high, echoing its 2022 stress levels. Microsoft disclosed in its October filing that $1.4 billion worth of GPUs sat unused due to power shortages in key data center regions. Power capacity in Northern Virginia and Santa Clara had been fully allocated through 2028, according to Reuters. The United States had built too many servers and too few substations. When Bloomberg asked SoftBank's CFO why the firm had sold Nvidia rather than hold through the AI boom, his reply was concise: because exponential curves always flatten, and we can't predict when. That sentiment rippled across Asia. Singapore's GIC quietly trimmed $3 billion in U.S. tech holdings. South Korea's National Pension Service disclosed similar reductions. Capital flight wasn't panic, it was preemption. In parallel, the dollar began to slip again. The DXY index fell from 103 to 97 in 3 weeks, driven by falling Treasury yields. Traders told the Financial Times that Japanese repatriation trades had drained dollar liquidity in Asia's morning sessions. When Tokyo opens, the dollar bleeds, one analyst said. The United States needed buyers for its debt, but its strongest ally was turning seller. By mid-November, the IMF's updated outlook warned that the combination of concentrated equity valuations and persistent fiscal deficits poses a systemic risk to dollar stability. The fund projected that a 100 basis point fall in foreign treasury demand could raise U.S. borrowing costs by 0.4%. That may sound small, but on $38 trillion of debt, it means $140 billion a year, roughly equivalent to the entire federal education budget. Meanwhile, data from Refinitiv showed that AI-related corporate bond issuance had reached $184 billion year to date, triple last year's figure. Much of it came from companies with negative free cash flow. When SoftBank walked away, lenders noticed. Spreads widened across the BBB tech segment, a silent tightening that the Fed could do little to offset. Trump's economic team, however, maintained public optimism. Bessent told reporters in early November that the tariff receipts will transition into wage income as factories return. Yet the Bureau of Labor Statistics reported that manufacturing payrolls had declined by 34,000 since August. Imports from China were down 12%, but shipments from Mexico and Vietnam rose 15%, suggesting production had shifted, just not home. Reuters quoted a U.S. Chamber of Commerce report calling the tariff revenue a circular tax on American households. It estimated that the average family paid an additional $2,600 per year due to higher prices on imported goods. Inflation's headline rate may have cooled to 3.2%, but core costs for housing and utilities remained elevated, with power prices 9% higher than last winter. The same energy constraint choking AI also punished households. In New York trading rooms, the focus turned to the yen. The Bank of Japan's October policy minutes, reviewed by Bloomberg, hinted at an exit from negative rates by early 2026. Currency strategists interpreted that as a green light for continued yen appreciation. Every uptick eroded dollar dominance further. JP Morgan analysts projected that if Japanese institutions repatriated even 10% of their U.S. bond holdings, it could push Treasury yields down 0.3 points short term, but send the dollar down another 8% globally. The Wall Street Journal reported that the Trump administration quietly asked Tokyo to coordinate exchange stability. But Japanese finance officials, still irritated by earlier tariff threats on autos, declined. One senior official told the paper, "We are stabilizing Japan, not the dollar." Amid the turmoil, the AI bubble continued to inflate domestically. Nvidia's quarterly report showed revenue up 35% quarter-on-quarter, yet its forward guidance missed Wall Street's loftiest projections. The stock dipped 6% in after-hours trading, erasing $300 billion in paper value, roughly the GDP of Finland. Investors ignored the warning and piled into smaller chip names, chasing the next miracle. Bloomberg's fund flow data showed $12 billion entering AI-themed ETFs in a single week, the second largest inflow on record. SoftBank's exit appeared even more prescient when Moody's issued a cautionary note titled AI Capital Expenditures at Unsustainable Pace. It highlighted that data center power demand in the U.S. South had risen 23% year-on-year, while grid expansion lagged at 4%. Without massive infrastructure upgrades, trillions in hardware could remain idle, precisely what Microsoft's filing confirmed. When asked by the Financial Times whether the AI boom could end like the dot-com crash, Bessent replied, "No. This time, productivity will catch up." But IMF productivity metrics released days later showed total factor productivity growth at 0.4%, unchanged from 2024. The data didn't lie, optimism did. By late November, the Federal Reserve's minutes revealed growing concern over asset concentration. Several members noted valuation pressures reminiscent of early 2000 patterns, yet policy options were limited. Cutting rates would fuel the bubble. Raising them would crash debt-heavy tech and widen the deficit further. The U.S. economy had boxed itself in. Across the Pacific, Japan launched the 2 trillion yen Next Silicon program, subsidizing domestic wafer plants and advanced lithography research. The Ministry of Economy, Trade, and Industry described it as a structural pivot away from foreign dependence. Bloomberg reported that part of the funding came directly from proceeds of the SoftBank Nvidia sale. In essence, Japan was converting America's bubble into its foundation. Currency markets reflected that shift. The yen climbed past 145 per dollar for the first time since 2022, while the euro strengthened modestly. The DXY index, a barometer of dollar strength, hit 96.4, its lowest in 2 years. Gold breached $4,200 an ounce as investors hedged against dollar erosion. The Financial Times quoted HSBC strategist Dara Mahir warning that structural dollar weakness has replaced cyclical volatility. Inside Washington, the narrative grew strained. Bessent continued to emphasize deficit reduction, citing Treasury's tariff intake and corporate tax receipts. But Bloomberg analysis showed that interest expense growth outpaced revenue by a factor of 3. The U.S. wasn't deleveraging, it was compounding. Economists at the Peterson Institute calculated that each 1% increase in the average borrowing rate added $350 billion annually to federal costs, almost exactly offsetting the value of all new tariffs combined. The disconnect between rhetoric and reality widened as consumer sentiment dropped. The University of Michigan's confidence index fell to 61.3, its lowest since 2023. Respondents cited rising living costs and fear of layoffs in tech. Job listings in information services declined 9% in October, the steepest fall since the pandemic. Corporate layoffs at data center contractors and chip suppliers rippled through Nevada and Arizona, the very states Trump had touted as new manufacturing hubs. Bloomberg summarized it bluntly. AI is consuming capital faster than it generates cash. Investors began rotating toward defensive sectors, utilities, healthcare, and gold miners. The Dow's relative strength shifted for the first time in 2 years away from tech leadership. A market built on optimism was beginning to price survival. As December approached, analysts focused on the Treasury's upcoming bond auction. With Japan out, questions mounted over who would absorb the supply. The answer came quietly: domestic money market funds, recycling liquidity from the Fed's reverse repo facility. It was the financial equivalent of the government buying its own IOUs. One strategist called it quantitative circularity, a phrase that captured the moment better than any headline. Then, unexpectedly, Bessent took to Bloomberg TV again. Asked if he worried about a dollar correction, he smiled and said, "The dollar remains the world's safest asset. There is no alternative." Yet the same day, China announced that its sovereign wealth fund had completed its first large-scale gold-settled trade for copper imports, worth $3.4 billion. The transaction bypassed both dollars and euros entirely. Within hours, gold-backed settlement volumes on Shanghai's exchange doubled. The shift was quiet but symbolic. For years, the dollar's dominance was unquestioned because no competitor existed. Now alternatives weren't hypothetical, they were operational. Markets responded instantly. The DXY slid another 0.8%, yields rose 10 basis points, and U.S. equity futures dipped before dawn. Late that night, in a Financial Times interview, a former Fed official described the situation succinctly. "You can't print credibility. Once it leaves, it doesn't return on schedule." He refused to be named, but the implication was unmistakable. By morning, Asian screens once again flashed red and white. The yen up, gold up, Nvidia down. And in Washington, Treasury's own data confirmed what SoftBank had already understood. The dollar wasn't collapsing from shock, but from exhaustion. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.